All right, so let's dive in.
Okay.
Today we're going deep into the world of investing,
Okay.
but not in the way, you might expect.
Mm-hmm.
We're cracking open
Right.
the Little Book of Common Sense Investing
Classic.
by John C. Bogle,
Yes.
the founder of Vanguard,
Yeah.
and the brain behind the first index mutual fund.
Uh-huh.
Now,
Yeah.
you probably already know this guy.
Yeah.
He was a giant in the finance world.
Right.
But what's really fascinating is how he flipped conventional investing wisdom on its head.
Mm-hmm.
He argues that the simplest approach is often the most effective.
He wasn't afraid to shake things up.
Yeah,
That's for sure.
for sure.
And his central idea
Yeah.
is deceptively simple.
Okay.
The best way to capture stock market returns
Mhm.
is to own the entire market.
Own the entire market.
Yes.
So not
Right.
picking hot stocks or trying to time the market perfectly.
Exactly.
That goes against everything.
Yeah.
We're bombarded with
Yeah. Right. In the financial news.
exactly. And that's where the beauty of Bogle's philosophy lies.
Okay.
Instead of stressing over individual companies,
Yeah.
you're essentially buying into a broadly diversified portfolio that mirrors a market index,
Okay.
like the S&P 500.
Okay. I'm starting to see the logic here.
Yeah.
It's like instead of betting on one horse in a race, you're betting on the entire racetrack.
That's a great way to put it.
Yeah.
Bogle uses the analogy of a pie.
Oh,
You want the whole pie,
the whole pie.
not just a slice,
Right.
because you never know which slice will perform best.
Makes sense.
But there's a deeper implication here
Okay.
that we need to unpack.
All right.
Think about it.
Mm-hmm.
What happens when unexpected events rock the market?
You mean like a sudden economic downturn?
Yeah.
Or a major geopolitical shift?
Precisely. Those are what we call black swan events.
Okay.
They're unpredictable,
Yeah.
but can have a huge impact. Oh, yeah. Now, if your portfolio is heavily concentrated
Right.
in a few sectors or companies,
Mm-hmm.
and one of those gets hit hard,
Mm-hmm.
you could be in for a nasty surprise.
Right.
But if you're spread across the entire market,
Yeah.
you're inherently more resilient.
Okay.
Some parts of the pie might shrink,
Yeah.
but others will grow,
Mm-hmm.
and overall,
Right.
you're still in the game.
Right.
This kind of diversification is incredibly powerful,
Yeah.
especially for long-term investors.
Okay, so owning the whole market makes sense for weathering those storms.
Yes.
But how do you actually do that?
Yeah, good question.
It's not like I can walk into a brokerage
That's
and
right.
say,
Yeah.
give me one market, please.
Well, that's where index funds come in.
Okay.
They're the key to unlocking the strategy.
Correct.
Think of them as a simple, low-cost way
Mm-hmm.
to buy a piece of that whole market pie.
So if I buy an S&P 500 index fund,
You're instantly invested in all 500 companies.
within that index,
Mm.
proportionate to their size in the market, no need to pick and choose individual stocks.
Right.
No agonizing
Yeah.
over which sectors are hot or not.
Sounds pretty hands-off.
It is.
Is that why they have lower fees
Yes.
than actively managed funds?
Exactly.
Okay.
Because there's no team of analysts
Right.
frantically trading stocks
Right.
trying to beat the market.
Mm-hmm.
The costs are significantly lower.
Okay.
And that, my friend, brings us to Bogle's next big idea.
Right.
The loser's game of trying to outsmart the market.
A loser's game.
Yes.
That sounds almost blasphemous.
I know, right?
The world of finance.
It is.
Tell me more.
Okay. Well, before we get into that, let's talk about something Bogle calls
Okay.
the relentless rules of humble arithmetic.
Oh, okay.
You see,
Yeah.
before any fees or expenses are taken out,
Yeah.
the average investor earns the market return.
Okay.
Makes sense, right?
Yeah, it does.
It's a zero-sum game.
Mm-hmm.
For every winner,
Yeah.
there's a loser.
Right.
Right.
Okay, I'm following so far, but I have a feeling those fees
Yeah.
are about to become very important.
You got it.
Okay.
Those seemingly small costs,
Yeah.
brokerage fees, fund expenses,
Mm-hmm.
taxes, even the price of financial advice,
Right.
they all eat away at your returns over time. And here's the kicker.
Oh, no.
Bogle called it the tyranny of compounding costs.
So even if you have a few winning years,
Yeah,
those costs are constantly nibbling away at your gains.
precisely.
Oh.
Let's imagine you have two investors.
Yeah.
both starting with $10,000.
All right.
One invests in an actively managed fund with a 2% annual fee.
Okay.
The other goes with a low-cost index fund,
Right.
charging just 0.2%.
Okay.
Let's say they both manage to achieve 7% average annual return before fees.
Yeah.
After 30 years, guess what the difference in their portfolios would be?
Okay, I'm no math whiz, but I'm guessing those seemingly small percentage points
Yeah,
make a big difference over time.
you're absolutely right.
Okay.
The investor in the low-cost index fund would end up with over $76,000.
Wow.
The one in the actively managed fund,
Yeah.
just over $43,000.
Wow.
That's a difference of over $33,000 just
Yeah.
because of fees.
Wow.
That's the tyranny of compounding costs in action.
I'm starting to see why Bogle called trying to get to market a loser's game.
Right.
But
Yeah.
if we're just aiming to match the market with index funds,
Yeah.
wouldn't our returns be
Yeah.
average?
That's a common misconception.
Okay,
Remember,
yeah.
the market tends to rise over the long term.
Yeah.
By simply capturing that growth through index funds, you're already ahead of the curve.
Okay.
But here's where it gets really interesting.
Okay.
Bogle contrasted this loser's game
Yeah.
with the magic of compounding returns.
Compounding.
Yeah.
Sounds familiar. But to be honest,
Yeah.
it's always felt a bit like financial sorcery to me.
It's simpler than you might think.
Okay.
It's the snowball effect of earning returns on your returns.
Okay.
Even a modest return, consistently reinvested over decades,
Yeah.
can lead to astonishing growth.
Yeah. So it's not about hitting home runs every year.
Right.
It's about steady, consistent growth over time.
Exactly.
Okay.
Bogle gives a powerful example in his book. Just $1 invested
Yeah.
at a 9.5% annual return.
Okay.
Grossed almost $94 over 50 years.
Wow.
And that's the beauty of index funds.
Okay.
They allow you to harness that compounding power
Yeah.
without the constant stress of trying to outsmart the market.
This is really starting to click for me.
Good.
But I'm curious.
Yeah.
Did everyone immediately embrace Bogle's ideas?
Not at all.
Okay.
His concept of index funds was initially met with a lot of skepticism.
Really?
Think about it. He was challenging the entire financial industry. Yeah.
Which was, in many ways, still is.
Yeah.
Built on the premise of active management and stock picking.
So he was proposing a financial revolution.
Exactly.
I love it.
Yeah.
But going up against that kind of established thinking,
Yeah.
he must have had some strong arguments and
Yeah.
supporters to back up his claims.
Oh, he absolutely did.
Okay.
And that's what we're going to explore next.
All right.
He had some pretty high-profile endorsements in his book,
Okay.
including one from Warren Buffett's right-hand man, Charles Munger.
Okay. Now I'm really intrigued.
Yeah.
Let's hear what they had to say.
So about those endorsements,
Yeah.
Charles Munger, Warren Buffett's partner at Berkshire Hathaway,
Right.
didn't hold back.
Okay.
He basically said the whole money management system
Yeah.
is built on a charade.
Oh, wow.
People pretending to do what they can't beat the market
Yeah.
and liking something they shouldn't.
Which is
Those hefty fees. That's a pretty bold statement.
It is.
Coming from someone at the top of the investing world.
Right.
What exactly did he say?
He said, and I quote,
Yep.
"The general systems of money management today require people to pretend to do something they can't do and like something they don't.
Yeah.
It's a funny business because on a net basis,
Yeah.
the whole investment management business together
Yeah.
gives no value added to all buyers combined."
Wow.
Yeah,
He's basically saying the entire industry is built on smoke and mirrors.
pretty much.
No wonder Bogle's index fund idea was so disruptive.
Right.
Yeah.
And Munger doesn't stop there.
Yeah.
He gets even more pointed,
Okay.
saying
Yeah.
mutual funds charge 2% per year, and then brokers switch people between funds,
Right.
costing another 3 to 4 percentage points.
Oh, wow.
The poor guy in the general public is getting a terrible product from the professionals.
Yeah.
I think it's disgusting.
Okay, so he's clearly on Bogle's side.
For sure.
But did anyone else of that stature support this common sense approach?
Absolutely. Bogle includes an endorsement from William Bernstein,
Okay.
a neurologist
A neurologist.
who also happens to be a financial advisor and author.
Wow, talk about a multidisciplinary perspective.
What else?
A neurologist and a financial whiz.
Yes.
Starting to think this whole index fund thing attracts some pretty interesting minds.
Right. It speaks to the inherent logic of the approach.
Yeah.
Bernstein argues that taking market risk is unavoidable.
Right.
But taking on additional risk by not diversifying properly is just foolish.
So you're saying index funds aren't just about keeping costs low?
Right.
They're also a smart way to manage risk.
Exactly.
Makes sense when you think about it. You're spreading your bets across the entire market.
Exactly. And Bernstein puts it quite succinctly.
Okay.
Avoid the problem, buy a well-run index fund, and own the whole market.
Simple and effective.
Right.
I like it.
Yeah.
But what about the argument that you'll never outperform the market with index funds?
Right.
Some people might see that as a limitation.
That's where we have to shift our perspective.
Okay.
Bogle isn't saying you can't outperform. He's saying the odds are stacked against you.
Okay.
And even if you do manage to beat the market one year, it's incredibly difficult to do it consistently.
So it's like trying to win the lottery over and over again.
Yeah.
Sure, it's possible.
Exactly.
But not very likely.
Right. And remember, even if you pick some winners, those costs we talked about, the tyranny of compounding costs, can still chip away at your gains, potentially leaving you worse off than if you just stuck with a simple index fund.
And Bogle had even more support.
Yes.
From a perhaps unexpected source.
You're talking about The Economist, right?
Yeah.
Even they acknowledged the shortcomings of active management, stating that most fund managers don't offer good value for the money they charge.
Yeah.
Their stock picking skills simply don't justify the high fees. And all that trading just eats into returns.
You know, it's one thing to hear this from John Bogle, the guy who literally invented index funds. But to see these endorsements from such diverse and respected sources, that really speaks volumes.
It does.
This isn't just some fringe idea. It's a legitimate approach that's gained traction over time.
It's a testament to the power of challenging conventional wisdom and focusing on the fundamentals. Simplicity, low costs, and long-term thinking. That's the essence of Bogle's common sense investing.
So we've covered a lot of ground here.
We have.
What would you say are the most important takeaways for our listeners? What do they really need to grasp about Bogle's approach?
I think the key takeaway is that investing doesn't have to be complicated or stressful. Bogle's philosophy is all about empowering individual investors to take control of their financial futures without getting caught up in the frenzy of the market.
It's a refreshing message. In a world where we're constantly bombarded with investment advice, hot tips, and get-rich-quick schemes, Bogle strips all that away.
He does.
And says, hey, focus on the basics, keep your costs low, and let time do its thing.
Exactly. It's about making informed decisions based on logic and evidence, not emotion or hype. And that brings us to a crucial question for our listeners. Knowing what you know now about Bogle's approach, how can you apply these principles to your own portfolio?
That's a great question. Are there practical steps our listeners can take to simplify their investing strategy and potentially improve their long-term outcomes?
I think the first step is to really examine your current strategy. Are you trying to time the market, jumping in and out of stocks or sectors based on the latest headlines? Or are you constantly chasing the hottest mutual funds, hoping to snag that elusive alpha? Because if you are, you might just be playing right into the hands of what Bogle called the croupiers of the financial system. Remember, they profit from complexity and churn, while the average investor often ends up paying the price.
So taking a step back and evaluating if your actions are truly adding value or simply adding cost.
Exactly.
That's crucial.
Absolutely. And if you find yourself constantly trading, reacting to every market blip and paying high fees, it might be time to consider a different approach.
Like shifting to a more passive strategy.
Right.
Centered around low-cost index funds.
Exactly.
That track the broad market.
Yes.
It sounds like that aligns more closely with Bogle's philosophy.
Precisely.
Okay.
Remember the power of compounding we discussed.
Yeah.
By simply capturing the market's long-term growth through a diversified index fund portfolio, you're setting yourself up to benefit from that magical snowball effect, all while minimizing costs and avoiding the pitfalls of trying to outsmart the market.
It's about aligning your investments with your long-term goals.
Yes.
Not getting swept up in the short-term noise.
Exactly.
Which, let's be honest, can be incredibly tempting in today's hyper-connected world.
It's all too easy to get caught up in the excitement of a bull market. Or panic during a downturn.
Yeah.
But Bogle reminds us that investing shouldn't be an emotional roller coaster. It's about discipline, patience, and sticking to a sound strategy.
This has been a fascinating deep dive.
It has.
Bogle's approach is so clear and logical, and yet it challenges so much of what we're told about building wealth.
And that's the beauty of common sense.
Yeah.
Sometimes the simplest solutions are the most effective.
Exactly.
Yeah.
So as we wrap up, I want to leave our listeners with a thought-provoking question, something to consider on their own investing journey.
All right.
Knowing what you now know about the principles of common sense investing. Simplicity, low costs, and long-term thinking. How might you apply them to your portfolio?
Good question.
Are there changes you could make to simplify your approach, reduce costs, and potentially improve your long-term outcomes?
That's a great question to think about.
It's definitely worth pondering.
It is.
Until next time.
Yeah.
Keep seeking knowledge.
Okay.
And remember, the best investment you can make is in yourself.
Well said.